The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to the final installment of the live Advanced Technical Analysis course. This is a bonus webinar and it will be an introduction to advanced trading theory. The purpose of this webinar is essentially to introduce you to a number of additional tools and techniques that haven't been covered in the Advanced Technical Analysis course, simply to illustrate that there is still a vast array of subject matter that falls under the banner of technical analysis that you have at your disposal. The purpose of the webinar will simply be to introduce a number of approaches and techniques. Certainly, if these do whet your appetite, then you will have the ability to do your own research further in terms of gaining a better understanding of these approaches, and you may decide at a later date to actually incorporate some of these techniques and these approaches into your overall trading and analysis strategies. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the material that we've covered in the Advanced Technical Analysis course and the material too that we'll cover in this webinar is educational material for the purposes of introducing you to various tools and techniques under the subject matter technical analysis. The purpose of this is also for you to improve your ability to both analyze and trade financial markets by understanding and using the tools and techniques that we are introducing you to. Just a quick recap of the course overview that we looked at in the Advanced Technical Analysis course. In the first week of the 3-week course, we introduced you to technical analysis, focused on the importance of price action, as well as being able to identify trends. We also looked at the importance of using support and resistance levels, as well as being able to identify them, and then looked at a very effective tool known as the Japanese candlestick approach. The end of the first week was concluded by a workshop which looked at incorporating the ideas and the techniques that we looked at in the previous 3 webinars in a more practical manner to give you a more hands-on overview of how these can be applied to markets. The second week followed the same procedure by looking at some theoretical topics such as price patterns, applying momentum and moving averages, and looking at trading the trend. This was a more formal approach in terms of building a trading strategy by using some techniques. That week, again, was concluded by the second of the 3 workshops. Once again, looking at the subject matter that had been covered in the previous 3 webinars and illustrating how these tools and techniques can be applied in a more practical sense in the real world. In the 3rd week, we looked at technical, fundamental, and sentiment analysis and how one can consider incorporating all of these 3 approaches together. We also looked at 2 very popular and very effective techniques that are applied to markets: Fibonacci number series and the respective ratios, as well as the Elliott wave methodology. We ended the educational focus by looking at ranges, breakouts, order flow, and confirmation. We looked at the ability and the importance to understand all of these various factors and how we can use them to apply an approach to reading and trading the financial markets. The Advanced Technical Analysis course was concluded by an end-of-course workshop, and this looked at incorporating all of the techniques, the majority of the techniques and ideas that had been focused on in the previous webinars, to also illustrate how a disciplined approach to both trading and analyzing markets can be developed. This webinar is the conclusion of the Advanced Technical Analysis course, and it is a bonus webinar. In today's webinar, we'll be looking at introducing you to foundations of volatility, seasonality. We'll take a close look in terms of what volatility is and what seasonality is, and how we can then incorporate some seasonal aspects around volatility as well. Two very important individuals in terms of theorists that have developed tools and techniques within the technical analysis framework are Gann and Gartley. We'll take a brief introduction into these two individuals. We'll also then move to introduce you to the concept known as speculative positioning, why we should consider understanding positioning in the market, and what this can tell us about the course of action that we may consider taking on board. We'll make a comparison between what institutional and retail markets are and the relative positioning that can exist between these two markets. Finally, we will introduce you to the COT indicator, and this will conclude the focus of this introduction to advanced trading theory. Okay, so let's take a look at the foundations of seasonal volatility. Firstly, we need to define each of these two terms. So, what is volatility then? Volatility refers to the size of changes in an instrument's value. Higher volatility means that the level of price can potentially be spread out over a larger range of values. This means large changes are likely to be seen over a short time period. Lower volatility, on the other hand, indicates that price changes in an instrument do not fluctuate dramatically, and changes occur at a steady pace over time. When we are looking at trends, in other words, clear directional moves in the market, trends are usually associated with a low volatility environment. What is seasonality? Seasonality refers to the movement or performance of price data that experiences regular and predictable changes each year. A predictable change or pattern in a price series that repeats over a one-year period can be regarded as a seasonal development. So essentially, if we're able to identify some kind of a recurring pattern at a regular interval over the course of a year, that would be regarded as a seasonal development. If we're able to identify that, we can perhaps consider taking certain courses of action from a trading perspective in the future. Let's take a look at this chart in front of us to get a better understanding of volatility. What we can see in this chart is that prices have moved from a low point towards the left-hand side of the portion of the chart up to a high point over a number of years towards the right-hand side of the chart. What we're able to do is to take a look at this uptrend and break it down into a few components. if we highlight two of these three sections, what we can observe by just simply looking at price action is that price swings seem to be quite large in size within what appears to be a defined range. If we compare that activity to two other components of that broader uptrend, we can see that we're able to identify two periods where the market has moved in a much clearer, defined upward direction. The clear difference between these two portions is not just the direction of the price, but also the size of the swings in price action. Price action will always swing from up to down or down to up. But what is clear during the directional phase is that the swings are much lower in size or in range and are clearly moving in an upward direction. By making a comparison between these very different outcomes in price activity, we can then conclude that the periods where we are seeing larger swings in price action represent periods where volatility is going up. And this is essentially what we mean by volatility. We can also notice and identify that the market in the most recent period has moved from a phase where we've seen a clear directional move in an upward direction to a period more recently where price swings and the size of those price swings have increased. And once again, price seems to be trading within a defined range of some sort. That means that we've seen a period where volatility has once again started to move higher. So we have three periods that we've been able to identify in terms of an increase in volatility. The trending components, i.e. the two components where the markets are moving in a clear and concise direction, represent periods where volatility is declining or volatility is falling. This then is a clear illustration of what we are referring to when we talk about volatility. We can then identify periods of rising volatility as A and B, periods of falling volatility C and D, and then finally the most recent increase in volatility as period E. Note too that this entire structure between phases where volatility is moving up and moving down comprises an entire uptrend from the low point to the high point as reflected by the dotted line you see in front of you. Hopefully, you now have a better understanding of what volatility actually is. The foundations of seasonal volatility. What we'll do now is we'll illustrate two very different market conditions. Let's assume that fear grips the market due, for example, to a geopolitical development. In this kind of environment, which we would typically refer to as the market becoming more risk averse, we would generally tend to see volatility spiking or an increase in volatility. What would typically occur during this environment is that the impact of this rise in fear is that stocks would likely be sold, demand for the yen and the Swiss franc would likely increase too, and demand for the US 10-year note would go up most likely as well. It's important to understand, though, that this development in volatility is not due to any seasonal aspect in the market. An event has occurred, whatever that geopolitical event is, it's forced the market to reassess its outlook on various aspects or various assets in the market, and positioning is then adjusted accordingly, together with an increase in volatility. As an alternative, let us assume that it was possible to determine that historically a stock performs in a certain way during a specified period each year. This then would represent a seasonal event. If, for example, we're looking at a particular stock and that stock typically increases in value between November and April, you could then look to establish a trade outlook that would consider going long the stock in November until April. And because we know that historically between November and April, the stock has moved in an upward direction, that would suggest that the stock usually trends in an upward direction during that period. We could then also assume that volatility during November and April is likely to fall. One alternative consideration from a trading strategy is that you could look to exploit this anticipated move lower in volatility, perhaps considering a trade in the options market as an illustration. This second example is a clear example of what we are talking about when we refer to seasonality aspects in the market. By being able to identify what seasonal implications are for the price would then imply an effect or an impact on volatility. And this essentially would then be your seasonal volatility impact on, for example, this particular stock that we are considering. Let's take a further discussion on seasonality and look at the commodity markets. In commodity markets, seasonality is usually evaluated around annual cycles, such as the summer and winter seasons. These seasons have an expected impact on the commodity and ultimately its price. For example, oil prices might be affected positively during a very cold winter, more so than during a normal winter. If we're looking at the price of another commodity, we might realize that the price of the commodity typically falls during certain times of the year, and perhaps might even fall further or more significantly if a market-related seasonal condition deteriorates more than expected. If, for example, we were looking at the cocoa market in 2016, an oversupply of cocoa saw a significant negative impact on the price, resulting in a devaluation of nearly 40%. Chart in front of you illustrates what happened to the price of cocoa in 2016. In looking at seasonality, we can also introduce the term seasonal charting. What seasonal charting essentially is the use of technical charting techniques to help identify and execute seasonal related trades. What we're essentially saying is that by looking at, for example, a particular commodity, you are aware of various seasonal aspects and seasonal impacts on that particular market. You can then focus your analysis on price activity, applying the various tools and techniques around technical analysis that form your discipline strategy to help further identify changes in market conditions around these seasonal related ideas that would then allow you to further fine-tune your trading strategies around the concepts that you're looking at. Let's, for example, assume that we were looking at trading the wheat market. Key points that we would need to consider when seasonal charting wheat would be, first of all, harvest and yield expectations. This would be a logical starting point in terms of understanding the key drivers within this market and the items that can potentially impact price on an annual basis. Reading the crop reports would then make a lot of sense. We would then be able to evaluate what this information that we've gathered from these reports have on supply. In other words, does it suggest that there's going to be an undersupply this year, or an oversupply, or for that matter, a normal supply of wheat on the market? This is important to assess because we then can come to some conclusions as to what impact this is likely to have on price. By applying seasonal charting, we can then go to the wheat chart. We can make an assessment of what the underlying technical conditions are that we're dealing with in that particular market. Combine that with the overview that we've just done vis-a-vis the supply side of wheat, and determine what our view is going forward with respect to the price. That will then be the foundations for any trading strategies that we may want to employ or take on board. We'll now move our focus on to GAN. William Delbert Gann was a finance trader in the early 20th century. He developed a number of technical analysis methods. Essentially, Gann used angles and geometric structures, which are used to predict areas of support and resistance on a price chart. Now, Gann analysis is an extensive overview of various tools and techniques. We'll focus on one or two areas in terms of introducing his approach to you. Gann's trading techniques were widely seen as innovative, and they still are. They are currently still studied and used by many traders today. His technique essentially focuses on angles and various geometric constructions. A technical tool called the Gann fan is something that can be used, and one of the tools that is regarded as generally one of the more popular elements of Gann analysis. Now, Gann's technical angles essentially divide time and price. What this does is it creates sections in the chart. This allows the user or the analyst to predict support and resistance levels, as well as identify key tops and bottoms. In other words, points where the trend is changing or market sentiment is shifting, to refer to it another way. The analysis is also used to predict future price moves. And the Gann fan, as we mentioned earlier, is one of the more popular tools that is used by Gann traders and is extensively applied. In front of you, you have an illustration of what a Gann fan looks like on a particular chart. What you can essentially assess from this chart is that you have 4 lines on either side, or 4 fan lines on either side of a central line. That central line is known as the trend line. You, the user of the Gann approach, will determine the points of that trend line. The fan lines are then automatically calculated. And what these lines essentially identify are important points of intersection in future price moves. You can see on the left-hand side, or the lower 4 fan lines are typically being used as levels of support. The trend line acts as resistance or support if breached, and then the market is moving higher. The next 4 Gann lines could be used as levels of resistance, and also important junctures in the movement of price. In other words, if we break through a particular level or arrive at a particular fan line, the market has arrived at a potentially important chart point. Could there potentially then be some form of a reversal at that level? We'll have to evaluate price action to gain a better understanding. That then is a brief introduction into W.D. Gann and principally his Gann-Fan methodology. What I'd just like to conclude before moving on about Gann is that Gann wrote a number of volumes which encompass all of his theories and ideas. It would require an extensive amount of research to become comfortable with the use of Gann analysis. There are individuals that have done this and believe firmly in the power of his tools and techniques. This is something that you could certainly consider to take on board yourself and perhaps then even incorporate Gann analysis in your overall trading strategy. H.M. Gartley was an esteemed author in the 1930s. He's most famous for writing a book called Profits in the Stock Markets. Here, he laid down the foundations for a certain type of charting pattern. This pattern, which we'll look at very shortly, is now called the Gartley pattern and is the most commonly used harmonic charting pattern today. Harmonic patterns use Fibonacci ratios, a topic that we looked at extensively in one of the webinars as part of the Advanced Technical Analysis course, and they use these Fibonacci ratios to build structures in markets to predict breakouts and retracements. Many traders and analysts use the Gartley patterns in conjunction with other chart patterns and indicators. It is used for big picture moves, and the patterns provide great insight into both the timing and magnitude of price movement. Elliott Wave, which again is another tool that we focused on in one of the earlier webinars as part of the Advanced Technical Analysis course, is another tool that makes similar trend predictions based on price movements. Let's take a closer look at how the Gartley pattern works. We'll look firstly at what is known as the bullish Gartley pattern. And what you see in front of you is price action that moves for a period in an upward direction and then for a period in a downward direction. We can break this price action into a number of different stages. Firstly, move up from 0 to 1, then the move down from 1 to 2, followed by the move up from 2 to 3. This is then followed by a move down from 3 to 4. The Gartley pattern will look at these various swings in terms of analyzing them to identify the end of the correction down relative to the up move from 0 to 1. Typically then, Fibonacci ratios are applied to identify these turning points. Now, with respect to the bullish Gartley pattern, the move down from 1 to 2, the first part of the correction, will travel to a price level that will equate to roughly 61.8% of the move from 0 through to 1. The move from 2 to 3 will travel to a price level that makes up roughly 38.2% of the decline from 1 to 2. The final phase of the correction, 3 to 4, will in turn travel to a price level of roughly 78.6% of the move from 0 to 1. Once we can identify the end of this move down from 3 to 4, that will mark the end of the correction and in turn provide a buying opportunity. So by applying this bullish Gartley pattern, we can see how the ultimate goal is for us to establish a trading strategy to go long once again. The bearish Gartley pattern works in exactly the same way. What you have here is you have a principal move from 0 down to 1. The first correction, or the first corrective phase from 1 to 2, will travel to a price level that equates to roughly 61.8% of the distance from 0 to 1. 2 to 3 will travel to a price level that equates roughly 38.2% of the move from 1 to 2. And then the final leg of the correction from 3 to 4 will travel to a price level that equates to roughly 78.6% of the move from 0 to 1. And again, if we can identify the end of the move from 3 to 4, that in turn will provide us with a trading strategy, i.e. an opportunity to go short as the downtrend once again resumes, given that the corrective move has run its course. For those of you who recall the discussions that we had in Elliott wave theory, you will probably notice that there are some degrees of similarities here to the Elliott wave structures that we looked at. The Gartley pattern then is great for price ranges. It can assist you in improving and leading to a more effective risk management approach. Patience is certainly necessary when applying these techniques, given that we need to allow for the correction to play out before we take a course of action with regards to a strategy. And at the end of the day, the Gartley pattern has a goal of providing a strategy or trading strategy for the user. That then is the introduction to the pattern known as the Gartley pattern.